Well, welcome everybody to the ClearVista Financial Perspectives April 2024 market update. We're glad you joined us. I'm founder and lead advisor here at ClearVista Financial. I'm joined today by fellow financial advisor Jesse Hamilton.
Hey everybody, welcome to the show. Pretty amazing, Mark. We made it through quarter one of 2024.
Q1 is gone and we're still here. We're still here. That eclipse thing's coming up pretty soon. There've been all sorts of crazy stories about that, but that will happen here soon. Hope you're doing well. We are going to record this for everybody so you can listen to it on our website in a couple of weeks if you missed it or wanted to clarify something. But we'll go ahead and get started. Jesse, we've got an agenda for today, don't we?
Yes, we do. So this is our standard agenda that we always talk about. We're going to cover our usual 4 indexes, focusing on the month of March. We'll talk about what happened. We'll also review the entire quarter and see how the indexes are doing. And then we'll make our comments on the markets and the current state of the economy. We'll talk about the Fed and what's going on with Jerome Powell and all his people that he works with that make big decisions for the impacts on our money. We'll talk about our outlook for 2024, and we'd love to hear your questions. So we have that same way of communicating with you, whether you're here live with us right now or you're watching this in a couple of weeks. We have 2 ways. The first is info@clearvistafinancial.com to email, or send us a text, 254-282-0495.
All right, great. Well, let's jump right in. I'm going to turn the camera off, Jesse, so folks listening on their phones or different places like that will have a little bit more real estate. Let's go ahead and jump in.
Great. So our first index today is going to be the S&P 500. This is the large cap index in the United States. Just a reminder for anyone who's new, this is a candle chart. Each candle is a trading day. Red candles are down days and green candles are up days. So this index rose 3.1% in March. And we really like the shape of this trend here, Mark. It's a general positive trend with a gradual rise over the month, and we do like that. We don't want to see big gaps or especially declines, but overall, this is a strong performance for the index. We'll cover a few of the individual components in a few moments, but there were a couple of new all-time highs, which is positive.
Yeah, and remember, we reclaimed the all-time high back from January of 2022. We reclaimed that, I think, the last day of February.
That's right.
And we had a few more highs. But you can kind of see here, this is, if you see the days that are red, there's a few folks that are a few days where there's a little bit of pullback. That is normal. That's going to happen even in a very healthy market. And that's a normal trend. We saw here towards the end of the month, we had a few days, 4 days actually, where we're selling off a little bit, but it reclaimed that trend. And you're going to have a lot of chop when you're climbing out of a bear market like we had in 22.
That's right. So on 320, 321, 27, and 28, you can see some new highs. And then as of today, the index has fallen slightly since then. So not a lot of movement.
Okay. All right, that sideways motion will happen for a while. And the market's consolidating, and then it either makes a move up or fails to move up, and we go into a short-term downward trend.
Right. So here's the NASDAQ, and it reminded me of a quote. We get quotes every day from our team, and it said, "A bull market is a bull. It's trying to throw its rider off," right?
Right.
So we see what happened here with the NASDAQ, our tech-heavy index, heavily influenced by those huge tech companies. It tends to be more volatile than the S&P, but this index underperformed the S&P in March, plus 1.79, and we're actually starting to see this lag behind overall large caps.
Right. And so, and some of those trends are changing, but still upward momentum, if you will. The first few days of April, we've seen that pull back a little bit, but the thing to remember here is that it is very healthy to have short-term pullbacks and then turn around and keep climbing up. And that's something we'll continue to watch. So we now, Jesse, are in a bull market. All right. From the end of 2021 through February, we were in a bear market. So when we look at things, depending on the overall market trends, when we're looking at a portfolio and deciding, do we need to go ahead and protect profits in here? We may not do that as quickly because we are in that bull market trend. So what about the small caps, Jesse?
So we saw some volatility here, but small caps were positive 3.22% in March, which is actually good news for market breadth. We're going to compare them in a second. But this chart is relatively smooth, no huge gaps. That did take a dip in the middle of the month, but we do like to see a smooth chart without these gaps. Clearly, investors, Mark, are big investors, small investors are becoming more interested in small caps during March.
Right, and that's a good sign that there are more participants adding to the breadth of the market.
Mm-hmm. And lastly, the long-term treasury, positive 0.47% in March, but just barely, showing a rise and then a steep sell-off that it didn't recover from. The second week of the month right there, you can see how many gaps down in a row that we saw. And this is supposed to be our safety net, right? And the price of the index is inversely correlated to yields. So this is showing yields rising.
Yeah, and there's something here. I don't want to mess up the chart or anything, but this period of time here, just drawing a little yellow line on there, that's when interest rates are rising.
Mm-hmm.
And that's a pretty fast rise that we saw in the long-term treasury index this month. And it's beginning to recover, but you can see even the last day of the month over here, we had a pretty big gap down. These should be doing the opposite of what they're doing now, because if we don't have that consistent position from the Federal Reserve, and we'll get that in just a minute, we don't have that consistent. People are expecting rate cuts. That's why it took off.
Mm-hmm.
And that long-term treasury went up in the first part of the month. Then there were some things going around that said, yeah, maybe not so fast. And that can affect the bond markets in many ways.
But mechanically, Mark, when they do make cuts, this index is supposed to rise.
It should rise. It should rise. And here we'll give a little disclosure here. Yeah, bonds are like a seesaw or a teeter-totter. You remember, Jesse, when you were a kid riding that? On one side of the teeter-totter is the price of the bond, and then on the other side is the coupon, or maybe that we might refer to it as the interest rate that it's paying in the form of dividends. And as the last 40 years, we've had falling interest rates, so that pushes up the value on one side. And the last 2 years, we really have seen rising interest rates, and that's causing the value of those bonds to go down.
Right.
So we looked at some things that we happen to own in our portfolio, and yes, there was a little bit of a sell-off in those positions, but they also paid a dividend, meaning paying the coupon.
So they are collecting some interest.
They are. And so when you look at your portfolio, if you see a bond holding that seems like it's down, check the dividends, because that may not be being reinvested. It could be just putting into your account, and your cash value is low.
So your overall performance is affected by those.
Yes, absolutely.
So we like to do a look back comparing large cap and small caps on this presentation. So here's a 2.5-year look back. The red and green line is the large cap index, and the blue line is the Russell small cap index. And I've updated it to show the last little piece there is March of this year. But we've been tracking it for 2.5 years now. You'll see in 2021, the blue line was well above the red and green line.
Meaning that small caps were outperforming the large caps at the time.
Correct. And we love to see that. And then they started to diverge in March of 2023, so about a year ago. And in order for us to see a broad-based rally, these need to be moving together, and preferably the blue line above the red line. So in December of last year, we saw a brief glimmer of hope. You can kind of see the rise quickly in December last year of the blue line. But in March, so last month, the indexes moved in parallel, which shows some strength, and we hope to see them eventually outperform. It was very close, Mark. So in March, the S&P was up 3.1, and the small caps were up 3.2. So technically, they did converge.
Right. We'll have to see if that continues, that pattern continues, because that is a very important indicator of overall market breadth.
Right. So here's another way to look at the comparison between large and small. When the black line is moving up, trending up like maybe a one slope, large caps are outperforming. So notice that most of 23, the black line's trending up, large caps are in the driver's seat. And then starting in November, there's that big shift, kind of that mountain peak looking in the middle of the chart. This means that small caps briefly regained control as the leader. And then notice quarter one of this year, 2024, for January, February, March, it's just moving sideways. It can't make up its mind. So neither index is proving to be a clear winner here.
Yeah, it's moving what we call a sideways pattern here that I've got the cursor highlighted on right now, the red dot. And if we see this black line fall below the green line here, then that will be an indication that the trend has changed. Small caps are in the driver's seat now, and we just haven't been able to break out of that. We don't know what's going on with that yet.
It'd be great if we could see that happen during April.
Yeah, it would. Okay, let's move on here.
So here's a chart that shows the percentage of stocks above their 200-day moving average. And Mark, do you mind explaining what a 200-day moving average means?
Yeah, a 200-day moving average is really, you want to see the little candle above the 200-day moving average. And when you're looking at a particular security or something, that's a sign of longer term strength and longer term momentum in that particular holding. And this one, what we saw was back in the fall. We don't go back to the fall, but back in October, the percentage of stocks that were trading above their 200-day moving average was only about 25%.
Right. It was well below the 20s, or in the 20s.
Now we're up in the 60s. As of the other day, we were up 63.91. All that means is that almost 64% of all stocks on the stock market are trading above their 200-day moving average, which is bullish.
It is.
But that still means there's, 37% or so that are trading below that. And so it's just something we glance at from time to time to see as a gauge of the overall breadth in the market. We love it to stay above 60. 70 is even better.
Yes,
we're not quite there yet, but these are all positive signs that the breadth is expanding in the market, and it's not just the Magnificent Seven or the Fab Four, as we're calling them now. Those particular stocks pushing up the indices.
But really, Mark, this entire chart is within 10% of each other. So within 50 to 60%. And that's really narrow. And my opinion is that we're not going to see this change either way until the Federal Reserve makes a decision.
Yeah, I think so.
So you mentioned the Fab Four. We've been saying the Magnificent Seven for over 6-7 months now. And really, a couple of these companies are not performing the way that they have been. And this chart shows it. You can find it in the Wall Street Journal if you're curious, if you want to see the colors with the companies. We can't show them for compliance reasons, but you can definitely find this online. Of course, we can't share which companies these are, but only 4 of the 7 have produced positive returns this year.
Yeah, and then two of the big ones are not. And you can read about this in the news. I'm sorry we can't share with you the companies because our compliance rules say that this could be considered an endorsement of a particular stock, and we can't do that. But yeah, this is something that we're seeing that at least 2 of the Magnificent Seven are struggling really well, and some of them had to do with sales and the drop and decline in demand of a particular product, and then certain countries impacting the product of the other company and closing off a market. So
exactly,
we would expect those stock prices to fall based on those couple of things. But the Fab Four is what we look at now to see how they're pushing the markets.
So that top company there in the orange line is trading well over 250 times its earnings, just for reference. That's pretty drawn out.
Yeah, and how long that will last, we don't know. Because trends can change, patterns can change, and let's move on.
So a lot of the ways that we manage money are looking at the 11 sectors of the economy. So these are the sectors, and I just wanted to show how they've been performing year to date. There's another article that I was reading about, the S&P is on the verge of its best year in 5 years. The index has hit several closing all-time highs, but what has changed recently for the positive is that all but one of the sectors have climbed to be positive this year. And the only sector underperforming is real estate. And in the last couple of weeks, energy actually took the lead position. It's been extremely volatile. Only in the last couple of weeks of the quarter really has that taken the lead. But it is positive to see that all of the sectors have a green return.
Yeah, that's another indicator of market breadth. We're not surprised by real estate, just because of the higher interest rates, especially commercial, as people are trying to refi short-term loans and things.
Mhm.
So this is also a positive sign here. So technology, that's something to notice here. It's in the middle of the pack.
Yeah.
It's in the middle of the pack. This is a change from the end of 2023 going into 2024 when technology was at the top. We blocked all the tickers here, but you can kind of see the average sector, and there are indices out there that track different sectors and things if you're interested in that.
That's right.
Okay.
So on the next, we're about to shift into a more macroeconomic time for our presentation, but I wanted to cover first quarter performance for these major indexes that we are tracking. So this covers January until the end of March. And let's go through each of them really quick.
Okay.
We talked about the NASDAQ, which has been the leader. It has recovered since its last peak, and it's positive 9.11%. That's actually lagging the S&P 500, which is the overall large cap index. It's up 10.16%. And I like to see that. That means that more large companies are performing well compared to just the technology.
Right. And so this is, Jesse, I think there's a little typo in there on the top one, but we can look at it later. The long-term treasury index is down 4.31% year to date. That's still about 39% off of its high back from 2020.
Yep.
And so that's that effect of rising interest rates during that period of time. The moderate portfolio index is a positive for year, which is good. And we use this quite often as a measurement of performance for some of our portfolios that we manage. But it's still down over 7% from November of 2021. So that has not recovered yet. And then finally, the equal weighted index. This is where each company gets one vote. It's kind of like the Senate. If you wanted to make an analogy, that recovered in March. That's up about 7.33%. It's fallen back a little bit since then, but we did set a new high and then pull back a little bit.
Yeah,
I
believe that was the last day of March that it recovered. So as of our last presentation, we hadn't had that yet.
Yeah.
And we do today. So that's very positive.
Yeah, absolutely. All right. Remember, you can send in your questions to info@clearvistafinancial.com. You don't have to do that during the webinar. You can do it anytime, or text us at 254-282-0495. And we do our best to try to get back with you same day, if not within 24 hours. If you're texting us, Jesse, at midnight on Saturday, I probably won't answer for a couple of days. But in normal hours, we usually get back to you the same day if we can. So let's jump right in and let's look at some macro questions or issues we're looking at. Go ahead, Jesse.
So we like to visit about the Federal Reserve. They met on March 19th and 20th last month. They decided to leave rates unchanged. So not any spectacular news that investors were looking for, but they definitely went into that Wednesday, a couple weeks ago, on edge, worried that this firmer than anticipated inflation could cause the central bank to dial back its signaling of how many rate cuts are likely in 2024. Each professional is going to have a different estimate of how many cuts are coming this year, if any cuts. We do expect cuts, and the market's pricing it in. But most officials,
this is all based on the dot plot,
right?
That the Federal Reserve does when they meet. Sometimes they don't release that dot plot, the dot plot is every Fed board member makes a prediction of what overall average rates will be
This is
in a
everybody
future.
that has a vote,
That's
right?
everybody has a vote. And it's still the majority, not all, the majority of the Fed regional presidents and Fed members voted that they suspect there'll be 3 rate cuts this year. And I say, don't hold your breath.
Yeah.
The data will drive their decisions, and we're going to get into some of that in just a second.
The more pessimistic voters are saying that there might be 1 cut in Q4 of this year.
Okay. All right. Good. All right. So real gross domestic product growth, GDP, was revised higher to a 3.4% annual rate from the prior estimate, and consensus expected at 3.2%.
So why do they revise things, Mark?
Well, it's an imperfect way of calculating economic growth. They're taking surveys from different. I used to do this. They're taking surveys from different businesses around the country and things, and they look at they do a household survey, and it takes them a long time to really gather all the data.
Yeah.
And so when they give us, they say the first quarter, GDP was up 1%. That's a guesstimate. All right. That's a guesstimate. So we, don't want to put all our faith in. So sometimes they come back and revise those numbers.
Well, mainly this came from consumer spending and government purchases, right?
That's right. So guess what? The government's spending money, and that's pushing the economy up.
I'm glad they do include it though in the GDP because it does have a huge influence on where the money goes.
Yeah, and really, I would be more interested in what consumer purchases are doing. Government spending, that's artificial. That doesn't show you the real health of the economy. So
what about nominal GDP?
Well, that's real GDP plus inflation. That was revised to a higher 5.1% annualized rate. And it was, the prior estimate was 4.9. So, we're watching corporate profits and things and looking at some of the things that the Fed looks at, and inflation's still a problem. Inflation's still a problem, and we're not seeing it. I mean, there's so much misinformation that's going out there. I mean, one of the big things that we've seen is, and I'm sorry it's coming from the White House, because, they're basically saying that inflation has fallen since Biden's been in office. And I'm not picking on a president or a former or previous or current president or anything like that. That doesn't mean that inflation is no longer happening.
Right.
And that's what they try to convey, that inflation's coming is no longer happening. We're still really close to 4%.
It's just driving at a slower speed.
That's right. We're still moving down the road, moving up the mountain, just at a slower rate of speed.
Just as a side note, Mark, we just finished up Easter, and I saw that chocolate prices are up 300%.
Yes.
So we're going to cover a few more commodities in a second.
That's a great reason not to have chocolate. Great reason not to have chocolate. Anyway, let's talk about personal income. It rose 0.3% in February. That fell short of the consensus expectation of 0.4% increase. Personal consumption rose 0.8% in February.
So people are consuming more than their income is rising.
Correct. And this we've had a slide on this in the past, but consumers are piling up debt like crazy. And that could be a problem in the future, especially if we start having layoffs. The overall, consensus here was that inflation still all remain above 2%, their 2% target. And of course, we had week before last, or maybe it was last week, we had that ongoing shipping disruptions in Baltimore Harbor, and then of course the Red Sea. I would not be surprised if we see more volatility in the inflation numbers in the month ahead.
So here's some other trends that we're noticing this month happening in the macro environment. You may notice that gold is breaking out, referring to specifically the gold indexes that track just the price of gold. They're reaching new all-time highs. I mentioned commodities, Mark. Agricultural commodities are spiking higher. So chocolate's in there, but also grains and all the things that we consume on a regular basis. The Fed's own research historically actually proves that food and agricultural commodities is the best predictor of future inflation.
Mm-hmm.
So it's not guaranteed, but we're seeing that these prices are commodity prices are continuing to rise.
So one thing that, and I don't know if do we have a slide on employment?
We do not.
Okay. There was a great article, Jesse, in the Wall Street Journal, I think just yesterday, talking about how economists are trying to get their hands around the unemployment rate versus the number of people that are in the workforce. And their conclusion is that the reason that the unemployment rate is staying low is because we have hundreds of thousands of people coming across the border.
Yeah.
And so there's a calculation that happens between, businesses and households, and they tie that to population. Well, we're underestimating our population now after almost 4 years of endless stream across the border, millions of people coming in.
Yeah.
And they're taking a lot of these jobs that are available out there. So, Jesse, we mentioned, or it's on the slide, the S&P 500 is overextended above its short-term and immediate term trend lines.
Well, yeah, it's just something that we've been noticing this month. An uptrend of over 100 sessions in the index is an extraordinary length of time.
Right. And, historically, new bull markets have some similar features. We were having a lot and back in October and September, we're having a lot of negative retail news.
Yeah.
There was a lot of doubt. There was social unrest, political angst. And then you have some skeptical retail investors and small fund managers.
People get FOMO.
Yeah, they get FOMO, or and they're now adding money back into the market because they don't want to miss out.
Yeah. So we always like to cover interest rates, and although they were not changed this month, it still affects Americans trying to take out debt, mortgages, and stuff.
Right, and that's the Federal Reserve overnight Fed funds rate. That's what we say is unchanged.
Yeah, it trickles down to the consumer.
Interest rates are move all the time.
Yeah.
And so here's that yield curve, and normally this is supposed to look the opposite. It should be flipped over if you put an x-axis or a y-axis, an x-axis, and flip it on the middle. That's what it should look like. So this yield curve has been really inverted since March of 2022. That's over 25 months of an inverted yield curve.
Yeah.
Now, Jesse, you pointed out last time about the historical significance of that.
Yeah. So in every other recession that's ever happened in the United States, this chart looked inverted. So it's supposed to be a hockey stick, but we're seeing the 1 month and the 3 month way higher than the 10-year and the 30-year. And leading economists all agree that historically that is true every time. But this one may be different. They also say that.
Yeah, we'll see. I don't see how it is, but I think the risk of a recession is a little bit further out than we were predicting in 2023. But the markets are responding to the hope of potential rate cuts in this year.
They are.
And so if they come out and, oh my goodness, raise rates again, that would cause a lot of turmoil in the markets.
Yes. So we never want to be gloom and doom here on this show. We always feel like there's hope for people, but this is kind of a scary graphic that we found this week on the Congressional Budget Office. They ran Bloomberg Economics ran 1 million forecast simulations on the US debt, and 88% of them show us borrowing on an unsustainable path.
And the Congressional Budget Office, the CBO, warned us that in their latest projections, U.S. federal government debt's on a path from currently around 97% of the gross domestic product last year to 116% by 2034. That's even higher than in World War II, Jesse. And the actual outlook is likely going to be worse. From a tax revenue to defense spending and interest rates, the CBO forecasts released earlier this year are underpinned by rosy assumptions. And if you plug in the market's current view on interest rates and the debt to GDP ratio, if it rises to 123% in 2034, and then you can assume as most in Washington do, that ex-President Donald Trump's tax cuts mainly stay in place, the burden even gets even wider or higher because if the Tax Cuts and Jobs Act tax rates expire, then you're going to have an increase in your taxes. If Congress maintains them, then you'll see this debt picture grow even worse.
That's right. We're teetering that line, Mark, of 1-to-1 ratio between GDP and debt. We don't want to see it go above that, but at 97% at the end of last year, we're very close. Think about that on a personal level. If you, let's just say somebody makes $100,000, that would be like them having $100,000 in personal debt and liabilities.
Yeah.
That's dangerous.
Even more. So it may take a crisis, folks, to get Congress to act. You've got Medicare and Social Security trust funds that are starting to be depleted. That may force some changes by as early as 2033. But we've got to do something about the printing presses printing money every day. All right. So how does this impact you?
We don't want to scare you.
No. I mean, we actually in our office are feeling much more positive about the market and the economy than we were the same time last year.
Yes, we are.
And so I think these are all positive things that we've talked about, but we just have to continue to monitor the data. We have to look at the things we're given. We can't try to predict for the future. No one can. We don't have a crystal ball, do we?
Right. These are the things that you're probably feeling as the listener, as the consumer, as an American. You're feeling each of these bullet points, whether you realize it or not. I carried several of them over from last month, but they're still extremely relevant. We mentioned inflation.
Yeah, and that's why I can't. I mean, it's funny, or I mean, not funny, but it's ludicrous that we keep being told by the government that inflation is falling, and yet I'm still paying every week higher prices for the groceries that I buy.
Yes, we are.
I think Washington, D.C. is out of touch with the rest of America, but it's still growing. Inflation's still growing, albeit at a lower pace or a slower pace, but it's still going up. So we're going to continue to watch that.
We have positive news, of course, that the indexes are showing strength, slightly improved breadth. These are good things for those of us who are investing. The bond indexes are still struggling. It's going to be a long time before we see that bond market recover.
Yeah. And interest rates are high, credit card debt's high. Oops, sorry, I didn't mean to do that. So there are a few things that we're watching. So what's the solution? That's what everybody wants to know, right?
So we're adapting to this dramatic shift, this mixed data. We have positive indicators, we have negative indicators, but really this is why we choose to manage investments in an active way using technical analysis, because things are changing every day.
And I think one of the biggest challenges, because we really, Jesse and I as financial advisors, yes, we are financial advisors, but we're behavioral therapists.
Yeah.
Our goal is to help our clients avoid making mistakes. And a lot of times those decisions are based on headlines or a late night television program.
Right.
We also more emotional than financial, but it sounds legitimate that I should worry and buy all sorts of different commodities and things and build that underground bunker. We don't think that's necessary. So it's natural for people to feel these ways, but that's why we counsel our clients to be able to kind of work through those emotions and avoid the headlines that are just a headline. They're not not data. And then, of course, this year, as it happens every 4 years, the presidential elections and who's going to take office. But I can tell you historically, it doesn't make a whole lot of difference in the stock market when it comes to who's in office. Not a whole lot. And there's plenty of studies out there. So we still think future's bright. That's good. What about your 401k? In the previous months, we introduced our 401k optimizer program that's available. If you're under 59 and a half, that may be a solution for you to get some help with managing your 401k. What we find in many employer plans is there's a quote computer advisor that's available to them, and they don't really pay attention to what's going on the rest of your life. But this is a new tool that you can use just give us a call, send us a message at info@clearvistafinancial.com or text us at 254-282-0495. And folks, you just need to make sure that you're partnering with someone that can help guide you, help hold your hand when emotions may be worrying you about things, because that's the last thing we want our clients to experience is worry.
Yeah, we see a majority of people holding most of their retirement assets in a retirement plan with their employer, 401k or any sort of plan like that. And if you just have that thing on the back burner, that's a majority of your net worth. And we want to make sure you're taking great care of it. Even if you don't have 100 investment options, we want to make sure that you have good care.
That's right. That's right. So let's go over here. What does this mean for your financial plan?
Our strategy really hasn't changed.
Nope.
If you are scared, we encourage you to check your statements. It doesn't matter what the balance shows. We can help you and guide you with that. Whether you want to talk to us or talk to a different professional, just make sure that you're getting some help. And we are here to educate you and to calm your nerves. That's what we want to do.
That's right. Well, Jesse, I think we're really at the end of our program for today. Remember, if you've got a question, we're happy to talk to you about that anytime. So text us a message, 254-282-0495. And we'd be happy to talk to you. Send us an email, info@clearvistafinancial.com. And so with that, folks, and Jesse and I, we just want to wish you a great month. Hope you enjoyed Easter. The solar eclipse is next week. It's supposed to be cloudy and rainy here, so maybe it's just going to be cold and dark for 4 minutes. But we wish you all the best. Please feel free to contact us anytime. Have a wonderful, wonderful day.